This is the one. This is the one that's got people believing in stupidity still after all this time.
Yep.
Welcome to Finance Reacts, where we break down all the latest hot topic takes from finance media's main gurus in order to help you make an informed decision and balanced approach to finance topics. Today, we're breaking down Dave Ramsey's advice on credit cards. If you're familiar with Dave, you know he has a zero-tolerance policy on any type of credit card use whatsoever. In particular, we are going to highlight Dave's advice to this viewer who has written into the Ramsey show bringing up the topic of credit card points redemption, the most persuasive and commonly used financial argument for credit card spending. Let's take a listen.
And I are in baby step 2 and are working hard to pay off our debt. The one issue we struggle with is not using credit cards. We use them to pay our utilities, groceries, and other monthly bills, but we never carry a balance. By doing this, we're able to travel for vacations for free using our points. What's wrong with doing this if we're not going into more debt? The age-old question, Dave. The age-old question. We've been exploring this topic on the fine print because it's one of the biggest objections we get here at Ramsey. People going, well, Dave, I pay off my card every month. I get some free stuff. What's the harm? Right?
So we should clue in Bank of America and Chase what portion of their marketing is working the best. And it is this crap.
The vacations, the points.
This is the one. This is the one that's got people believing in stupidity still after all this time.
Yep. And here's what happens, and you can listen to the true cost of credit card rewards. This is the second fine print episode that we released, and we dug into this with an ex-Capital One insider.
Okay, what did they say?
She said they run 10,000 experiments a year on people to figure out what's going to get them to spend more, to use the points. And one of the biggest ways they do it is through the points. Because you know how the points work. They don't say it's $500. They say you're going to get 128,000 points that you can use to redeem flights that cost $74,000. And the points change every day. And there's blackout dates and there's restrictions. And on top of that, the whole 2% cash back. That one is one of my favorites. Because you know what 2% of $1,000 is?
$20.
$20 to spend $1,000.
Let's break down the listener's argument and analyze Dave's response. But first, a flashback to how the modern-day credit card, as we know it, started. The first credit card to gain widespread use was the Diners Club card in the 1950s, reaching 10,000 members and 28 restaurants in its first year of operation. The card was invented when the founder, Frank McNamara, left his wallet at home while out dining. Soon after, financial products like the Visa, named so because it allegedly sounded nearly the same in every language, and the Master Charge, later rebranded as MasterCard, were introduced as revolving credit concept cards in the late 60s and 70s. With the help of technological breakthroughs, such as the magnetic stripe, the credit card became a staple in the average consumer's financial arsenal. When you use a credit card, the credit card companies offer rebate incentives in order to retain consumer loyalty and to incentivize spending on your card. Active spending on your credit card allows the credit card companies to earn revenue on payment processing fees and interest income. In 2020, credit card companies brought in a reported $176 billion, of which $76 billion was interest income. With so much profit at stake, credit card companies look to gain and retain customers by deploying enticing spending reward strategies such as loyalty reward programs. These loyalty rewards can come in a variety of benefits such as free flights, hotel stays, gift cards, and even cash back. A new study won by ValueBettingX in 2023 showed 58% of cardholders are willing to switch their current go-to-card to a new one if it offers higher cashback rates, and 78% of cardholders say cashback is a strong incentive to stay with a card provider. It was also reported nearly 60% of all credit card users actively check for merchant partner offers before shopping with their credit card. But why is Dave, a savvy, experienced investor with a proven track record, so against credit card use? To truly understand Dave's side of the argument, we need to understand the level of market research and data credit card companies use in order to come up with their respective reward systems and how physiologically enticing they are designed to be in order to extract the most money out of the consumer. According to a 2008 study entitled Monopoly Money by researchers Priya Raghubar and Joydeep Srivastava, the pain of paying is greater when we pay with cash or debit. Spending actual physical dollars makes the monetary loss real, whereas using a credit card allows you to delay the loss for the time being while enjoying the gratification of the immediate purchase. Credit cards give our brains a chance to focus only on the positive, namely our newly purchased goods or services, and tends to make us more liberal overall when we decide what or how much to buy. Furthermore, a Dun and Bradstreet study concludes that people who use credit cards spend on average 12 to 18% more on transactions than those who use cash. In certain small ticket purchases, the difference between cash and non-cash customers can be far higher. The average McDonald's transaction, for example, increases from $4.50 to $7 when customers use a credit card instead of cash. Credit card companies also have very sophisticated data collection abilities on consumer purchase history. This allows them to calculate the probability of you spending more money on dining out or hotel stays with a partner affiliate if they offer 3x the points, or the likelihood of you spending more to reach a heightened status level on your points redemption account. These strategies are based on significant amount of market and consumer research that these companies spend billions and billions on to have an advantage against you, the consumer. Finally, to fully understand why Dave gives the advice, we need to take a deep dive into Dave's target audience. Who does Dave mainly make content for? Of course, people from all stripes of life can learn from Dave's lessons, but his main audience, by his own admission, is Middle America. The middle-class parents who are drowning in student loans that they signed up for when they were just teenagers and now realize they have no plan to pay them back. The hopeful young professional who signed up for that $60,000 car loan at 8% with no cash in the bank because they got their first job and felt they needed it. The 18-year-old who just got their first credit card because everyone told them they need it to build credit. This is Dave's target audience. This is also the most vulnerable target for the credit card companies. This audience also plays a significant role in shaping Dave's perspective and own bias. Dave advises clients who are in financial ruin, usually as a cause of overspending and borrowing. Time and time again, Dave is exposed to extreme economic conditions from people who have hit rock bottom. Think about it: if someone uses a credit card responsibly without ever incurring interest or falling a victim to overspending marketing ploys, why would they ever come into contact with Dave? Consumers who have hit financial hardship are much more likely to come across Dave Ramsey. Conversely, Dave's opinions are much more likely to be skewed towards credit cards as a result of the sample pool of consumers he interacts with on a daily basis. As Dave has pointed out, according to a variety of different research firms, only an estimated 45% of credit card users pay their bill off in full at the end of the month, causing high interest payments and thus negating any possible benefits of loyalty points. The lower the income you have, the less likely you are to pay your balance off in full. These same households are much less likely to take advantage of any travel and redemption benefits, and are also much less likely to be given access to the majority of high cash-back yielding credit cards, as many of these cards are reserved for high-income earners with above 700 credit scores. The Federal Reserve, which has been tracking the distributional effects of card rewards, released its December 2022 report and estimates an annual redistribution of $15 billion in rewards value from poorer people to richer people, from lower educated people to highly educated people. This is because the higher income the cardholder, the less likely they are to pay interest and carry a balance. In other words, low to middle income consumers pay most of the fees, interest, and annual cardholder payments, while upper middle class to rich consumers reap most of the incentive benefits. Given all Dave knows regarding credit card companies' vast resources in regards to data collection, focused consumer overspend strategies, and given the fact the majority of consumers do not pay their balance off in full, and finally given the fact his target audience is the very audience that have become a target for these conglomerates as their most profitable customers, Do you have a better understanding why Dave recommends staying away from credit cards altogether? Have you reconsidered your own positions on the true profitability of reward incentive-based cards? Can you understand how Dave may see this advice as the best way for the largest amount of people to remain financially free? Let me know in the comments below. If you got any added perspective on the topic of credit cards from this video, please hit the like and subscribe button and the notification bell. It really helps out the channel and allows me to make more videos like this one.